Hey, what's going on, my friends? In this video, we're going to talk about how you can keep more of your money. Hopefully, by now, you've already, started your own business and or have joined the gig economy, specifically either, TaskRabbit, maybe you signed up with Upwork or Fiverr, or maybe you've done you're part of one of the other bigger, more common gig apps like uh, Uber, Lyft, DoorDash, Grubhub. The list goes on. But basically, if you are self-employed, well, you can keep a lot more of your money by following along with our videos here on this channel. And specifically in this video, we're going to talk about tax write-offs and deductions. And again, if you are part of the gig economy and if you are a tasker on TaskRabbit, well, I have a question that someone asked me saying, how does taxes work for the tasker? Does TR hold federal and or state tax? Or does the tasker need to save their money for tax season? So to answer the question directly, how does taxes work for the tasker? Well, there are no taxes taking out from TaskRabbit on their behalf, and the same can be said with Uber or DoorDash or any of these gig apps. The way to think about it is you are a business. Yes, you might say, "Well, no, I have my job, and this is just a side hustle. It's something I do on the side." Again, you need to start thinking about yourself like a business, because that is essentially what you are. And that's how these companies look at you. Not like you are an employee. No, they're not taking out taxes. They are not. What was the other part of his question? Does TR hold federal and or state taxes? No, they do not. And then the last part of his question is, does the tasker need to save their money for tax season? Yes. You want to save a percentage of your money towards taxes. And I mean, the rule of thumb is what? What do they say? 30%, should go towards taxes. So you should essentially have money set aside in a separate savings account, not your regular savings account, not your emergency savings account, which, yes, those should be different right there alone too. Personally, that's what I believe. The way I have my account set up, those are two different accounts alone. But you also want to consider having an account that has money saved that is going to go towards your taxes. That said, hopefully you guys are still rolling along with me, and you will be able to benefit from these 15 tax deductions and benefits that will help you with keeping more of your money. Yes, keeping more of your money. Because again, you might think, well, I'm just an Uber driver, or I'm just someone who works on Fiverr or Upwork. Well, you are basically a business. And the way Uber and Fiverr and these gig apps look at you, well, it's like you guys have a partnership, essentially. You're a business, they are a business, and you guys are working together to fulfill the need of a customer. Period. Bam. Really simple. You basically have a contract in place that says, I'm going to, they're going to provide you with a customer, a lead, and you need to convert that lead, that customer, prospective customer, into a satisfied customer. Perform the job that they are requesting, do the job, and then you'll get paid. And it's as simple as that. They don't hold taxes. They don't keep anything. They give you whatever the agreed amount is. And that's that. Now, of course, different gig apps might be slightly different depending on what app you are on. Specifically with like TaskRabbit, it's kind of aligned with what I just said. It's really clear, really cut, simple. They don't hold anything. And it is your job as the self-employed individual, as the independent contractor, as the business, to be responsible for paying taxes on the money that you make. That said, like I said, the general rule of thumb that a lot of financial advisors recommend is 30% that you want to set aside. And every business is different. But the big thing is knowing what are write-offs, knowing, these kind of different little ways you can bring down the amount of money you'll have to pay in taxes, which in theory allows you to keep more of your money and basically is allowing you to grow your business faster because you have more money to work with instead of having to pay it all out for taxes. So we're going to jump into this Investopedia article that, as you can see, Guide to Successful Self-Employment. And this has in particular 15 tax deductions and benefits that you guys can utilize to help you with keeping more of your self-employed or small business money. So number one on the list is self-employment tax. It says the self-employment tax refers to the Medicare and Social Security taxes that self-employed people must pay. These include freelancers, independent contractors, and small business owners. The self-employment tax rate is 15.3%, which includes 12.4% for Social Security and 2.9% for Medicare. Employers and employees share the self-employment tax. Each pays 7.65%. People who are fully self-employed pay the total themselves. So again, self-employment tax rate is 15.3%. But if you were an employee working with at someone's company, you would be paying half of that, 7.65%. Because you are self-employed, you pay the employer because you are basically the boss, you're the employer, and then you're also the employee. You're self-employed, you're doing the work. Like I said, think about yourself like a business, and the way this is kind of written out can maybe help you kind of vision that better, where you are the business owner as well as the employee. Therefore, you're responsible for the total amount yourself. And an additionally 0.9% Medicare tax rate applies if income is above a certain threshold amount. And the threshold for married filing jointly is $250,000. Married filing separate is $125,000. If you are single, the threshold is $200,000. Head of household with qualifying person, $200,000, and qualifying widower with dependent child, $200,000. The income thresholds for additional Medicare tax apply not just to self-employment income, but to your combined wages, compensation, and self-employment income. So if you have $100,000 in self-employment income and your spouse has $160,000 in employee wages, you'll have to pay the additional Medicare tax of 0.9% on the $10,000, which by which your joint income exceeds the $250,000 threshold. Paying extra taxes to be your own boss, clearly, it's no fun. The good news is that the self-employment tax will cost you less than you might think, because you get to deduct half of your self-employment tax from your net income when calculating your income tax. The IRS treats the employer portion of the self-employment tax as a business expense and allows you to deduct it accordingly. So again, I hope that part makes sense. Paying extra, the good news is that self-employment tax will cost you less than you might think, because you get to deduct half of your self-employment tax from your net income when calculating your income tax. The IRS treats the employer portion, not the employee, but the employer portion of your self-employment tax as a business expense. So it goes on to say, it is important to note that the self-employment tax refers to Social Security and Medicare taxes, similar to FICA paid by an employer. When a taxpayer takes a deduction of 1/2 of the self-employment tax, it is only a deduction for the calculation of that taxpayer's income tax. It does not reduce the net earnings from self-employment or reduce the self-employment tax itself. So as you guys can see, when a taxpayer takes a deduction of 1/2 of the self-employment tax, it is only a deduction for the calculation of that taxpayer's income total. It does not reduce the net earnings from the self-employment or reduce self-employment tax itself. Remember, you're paying the first 7.65% whether you're self-employed or work for someone else. And when you work for someone else, you're indirectly paying the employer portion because that's money your employer can't afford to add to your salary. Self-employed individuals determine their net income from self-employment and deductions based on their method of accounting. Most self-employed individuals use the cash method of accounting and will therefore include all income actually or constructively received during the period and all deductions actually paid during the period when determining their net income from self-employment. Number 2 on the list is home office. The home office deduction is one of the more complex of all. In short, the cost of any workspace you use regularly and exclusively for your business, regardless of whether you rent or own it, can be deducted as a home office expense. You are basically on the honor system, but you should be prepared to defend your deduction in the event of an IRS audit. One way to do this is to prepare a diagram of your workspace with accurate measurements in case you are required to submit this information to substantiate your deduction, which uses the square footage of your workspace in its calculation. In addition to the office space itself, the expenses you can deduct for your home office include the business percentage of deductible mortgage interest, home depreciation, utilities, homeowners insurance, and repairs that you pay during the during the year. If your home office occupies 15% of your home, for example, then 15% of annual electricity bill becomes tax deductible. Some of these deductions, such as mortgage interest and home depreciation, apply only to those who own rather than rent their home office space. So, how do you calculate the home office deduction? Some of you guys might be wondering, hey, I got a little office in my place that I dedicated just to use for work. You work on Fiverr, you do consulting work, you do graphic design work, and you have a small office in your apartment, small little corner of your apartment. You bought a little office. It's just for your work. You got a little laptop. It's just for your work. Little monitor. It's just for your work. It's where you get grinding because it's just for your work. Yes, it might be a side hustle, and you still decided to convert a small little space in your apartment. Maybe you have a 2-bedroom apartment, a studio apartment, whatever it might be. There might be a small portion of that is dedicated exclusively towards your side hustle, which is basically a business. And that little office space is like your office, right? Think about, like I said, you are a business. Well, you have 2 choices for calculating your home office deduction, the standard method or the simplified option. And you don't have to use the same method every year. The standard method requires you to calculate your actual home office expenses and keep detailed records in the event of an audit. The simplified option lets you multiply an IRS determined rate by your home office square footage. To use the simplified option, your home office must not be larger than 300 square feet, and you cannot deduct depreciation or home-related itemized deductions. The simplified option is clear choice if you're pressed for time or can't pull together good records of your deductible home office expenses. However, because the simplified option is calculated as $5 per square foot with a maximum of 300 square feet, the most you'll be able to deduct is $1,500. So if you want to maximize your home office deduction, you'll want to calculate the deduction using both the regular and simplified methods to find out which one will give you greater benefit. If you choose the regular method, calculate the deduction using IRS Form 8829, expenses for business use of your home. Now, I will say the easiest way I believe you guys will be able to manage and kind of keep insight of your business expenses as well as personal expenses, but business expenses and kind of cash flow, but then other aspects of helping you with managing your self-employed business is using QuickBooks. QuickBooks is absolutely was a game changer for me, something that I wish I knew about earlier, something that I use for my self-employed business as well as my actual uh, LLC. And I recommend it to pretty much anyone out there who needs software, who needs an easy way to help with pushing your records and converting it, not just so that you can see how things are going, that you can keep track of of everything, but also to help you with when it's tax time, because QuickBooks is owned by Intuit, which I mean, they just own so many different platforms and different software that's going to help you as a self-employed or business owner. So keeping things moving, because yes, tax time is coming and you guys are going to want to know about all of these goodies so that you will be better positioned to keep more of your hard-earned money. Number 3 on the list is internet and phone bills. Regardless of whether you claim the home office deduction, you can deduct the business portion of your of your phone, fax, and internet expenses. The key is to deduct only the expenses directly related to your business. For example, you could deduct the internet related cost of running a website for your business. If you have just one phone line, you shouldn't deduct your entire phone bill. Of course, if your entire monthly phone bill is being used on a personal level and on a business level, well, then it's probably going to be split 50-50. So as you can see here, it says, according to the IRS, you can't deduct the cost of basic local telephone service, including any taxes, for the first telephone line you have in your home, even if you have an office in your home. However, you can deduct 100% of the additional cost of long distance business calls or the cost of a second phone line dedicated solely to your business. Hopefully that makes sense. Number 4 on the list is health insurance premiums. If you are self-employed, pay for your own health insurance premiums and are not eligible to participate in a plan through your spouse's employer, well, you can deduct all of your health, dental, and qualified long-term care insurance premiums. You can also deduct premiums that you paid to provide coverage for your spouse, your dependents, and your children who were younger than 27 at year end, even if they aren't dependents on your taxes. Calculate the deduction using the Self-Employed Health Insurance Deduction Worksheet in IRS Publication 535. Like I said a moment ago, things like your health insurance premiums, things like your home office, and what we're going to see number 5, which is meals, will be easy for you to manage all of this when it's tax time and throughout the year when you go in there on a weekly basis using QuickBooks. Again, very easy, and kind of a lot of it will be set up automatically. You get in there, set things up automatically. So if there's payments coming in from your health insurance premiums, well, you can set it up where it's just going to automatically go in to the appropriate category and you don't have to worry about anything. And it's going to be logged in there, recorded, and you're good to go. Keep grinding and worried about, just worrying about and focusing on the things that you do as a business owner and not having to really jump into all this other nitty gritty stuff when it comes time to accounting and tax time. But of course, I know you care about those things and might not necessarily have the money to go out there and pay the most expensive accountant, which I also do recommend at some point you do speak with professional financial advisors and maybe getting legal advice as well, because all of these things not positions, but people, these specialists will have probably additional insight to certain questions and ways that you can be better protected and saving and keeping more of your money than someone like myself and others that you might come across that are good with being able to present the information, but not necessarily specialized in it. Again, you might feel like, well, I don't know, man. All the time and energy we spend researching these topics and producing this content, we do come off and start to feel more experienced in particular fields and talking about some of these topics. But again, there are professional CPAs and whatnot, and people that truly specialize in getting providing financial advice and legal advice and whatnot. So number 5 on the list is meals. A meal is a tax-deductible business expense when you are traveling for business at a business conference or entertaining a client. The meal cannot be lavish or extravagant under the circumstances, and in the past, you could only deduct 50% of the meal's actual cost if you keep your receipts, or 50% of the standard meal allowance if you keep records of the time, place, and business purpose of your travel, but not your actual meal receipts. Unfortunately, this means the desk lunch is not tax deductible. However, the deduction has been amended. According to the Consolidated Appropriations Act 2021, HR 133, temporary allowance of full deduction for business meals. So 100% of business meals can be written off. The bill temporarily allows 100% business expense deduction for meals rather than the current 50%, as long as the expense is for food or beverages provided by a restaurant. This provision is effective for expenses incurred after December 31st, 2020, and expires at the end of 2022. The standard meal allowance is the federal M&IE rate, which is updated every fiscal year effective October 1st. The current rate and M&IE breakdown can be found on the U.S. General Service Administration GSA website. The lunch you eat alone at your desk, again, is not tax deductible. And it says, additionally, prior to the Tax Cuts and Jobs Act for meals and entertainment expenses were considered in unison for tax years 2018 and later. According to the IRS, if food or beverages are provided during or at an entertainment event, and the food and beverages were purchased separately from the entertainment, or the cost of the food and beverages were stated separately from the cost of the entertainment on one or more bills, invoices, or receipts, you may be able to deduct the separately stated costs as a meal expenses. However, if the meals are not separately identified on the receipt, they cannot be deducted at all because, as many of you may know, maybe you don't know, how deductions around entertainment expenses are no longer allowed. Pretty much what you want to know is, again, the meal cannot be lavish or extravagant under any circumstances. And, the temporary bill allows 100% of business expense deduction for meals. And at the beginning, as it mentions, a meal is a tax-deductible expense, business expense, when you are traveling for business at a business conference or entertaining a client. Now, one of the other things, again, this isn't legal or financial advice, was under the impression, and we'll create another video speaking more in depth about some of these topics, including meals, because I was under the impression that a meal could also be written off if you are with employees having a business discussion. So as long as you're having some sort of business discussion with a prospective customer or with employees or contractors that you work with, I was under the impression any of that would fall under the meals tax deductible kind of option. But again, not legal or financial advice. That is something that I will look into, and maybe we'll create another video diving more into meals. But as you can see, at least we know for certain traveling for business at a business conference or entertaining a client is a write-off. Number 6 is travel. To qualify as a tax deduction, business travel must last longer than an ordinary workday, requiring you to get sleep or rest and take place away from the general area of your tax home, usually outside the city where your business is located. Further, to be considered a business trip, you should have a specific business purpose planned before you leave home, and you must actually engage in business activity, such as finding new customers, meeting with clients, or learning new skills directly related to your business while you are on the road. Keep complete and accurate records and receipts for your business travel, expenses, and activities, as this deduction often draws scrutiny from the IRS. Very important here, my friends. Keep accurate records. Deductible travel expenses include the cost of transportation to and from your destination, such as the plane fare, the cost of transportation at your destination, such as a car rental, Uber fare, or subway tickets, and then lodging and meals. You can't deduct lavish or extravagant expenses, but you don't have to choose the cheapest options available either. Don't forget that you, not your fellow taxpayers, will be paying the bulk of your travel costs, so it's in your interest to keep them reasonable. Your travel expenses for businesses are 100% deductible, except for meals, which, well, this hasn't been updated, obviously, because meals are 100% deductible, as we just covered and mentioned. If trip combines businesses with pleasure, things get a lot more complicated. And so, in a nutshell, you can only deduct the expenses related to your business portion of your trip. If your spouse who does not work for you as an employee joins you on a business trip, for example, you could only deduct the portion of lodging and transportation costs that would have been incurred if you had traveled alone. Don't forget that the business part of your trip also needs to be planned ahead. So, if you happen to have a business trip to California and you're here in Boston, Massachusetts, well, you can write off your plane. You can write off the uh, travel, Uber or cab fare to your hotel. You can write off your hotel expenses. You can write off the meals that you have over your meeting with your customer, your prospective client. Maybe you're going to a conference that's going to help you with learning a new skill set that will allow you to better market or network with other prospective customers. That is all a write-off. Yes, you can invest in your business to help you with being able to potentially grow it so that it will be better, so that it will generate more income, and in exchange, as a reward, so to speak, or again, it only makes sense. You're investing in your business. You're investing in yourself. You want to be bigger. You want to get larger. You want to make more money. And because of that, they will help you with using that as a write-off. Some things, again, are 100% deductible. And meals, which previously were not, are now also 100% deductible. Very cool. Great to see. But it only really is, it's money. It's only dope. It's only a good thing if you benefit from them. So next up on the list, number 7, is vehicle use. Excuse me, my friends. So as you can see, number 7 is vehicle use. When you use your car for business, your expenses for those drives are tax deductible. Make sure you keep excellent records of the date, mileage, and purpose for each trip, and don't try to claim personal car trips as business car trips. You can calculate your deduction using either the standard mileage rate determined annually by the IRS or your actual expenses. The standard mileage rates are 57.5 cents per mile in 2020 and 56 cents per mile in 2021. Using the standard mileage rate is easiest because it requires minimal record keeping and calculation. All you got to do is write down the business miles you drive and the dates you drive them. Then multiply your total annual business miles by the standard mileage rate, and this amount is your total deductible expense. To use the actual expense method, you must calculate the percentage of driving you did for your business all year, as well as the total cost of operating your car, which includes your depreciation, the gas, oil changes, registration fees, any repairs, and of course your car insurance. If you spent $3,000 on car operating expenses and used your car for business 10% of the time, your deduction would be $300. And if you want to use the standard mileage rate on your car you own, you need to use that method in the first year the car is available for use in your business. And in later years, you can choose to use either the standard mileage rate or switch to actual expenses. If you are leasing a vehicle and wish to use the standard mileage rate, you must use the standard mileage rate in each year of the lease period. So you can't flip-flop. Once you start, you got to continue with it. And as with the home office deduction, it may be worth calculating your deduction both ways so you can claim the larger amount. Again, I recommend using software like QuickBooks, which does help you with logging and tracking your miles that you drive when you are using your vehicle for business purposes. It makes it very, very easy. Just simplifies the process. I'm pulling up my phone right now, and there's actually some other software that I used to use called Mile IQ that you can use to help you with tracking your vehicle mileage as well. And I'll try to remember to post some links down below to some of these companies that I do believe you guys will benefit from with each of these different ideas that we are covering here. So number 8 is interest. Interest on a business loan from a bank is a tax-deductible business expense. If a loan is used for both business and personal purposes, the business portion of the loan's interest expense is allocated based on the allocation of the loan's proceeds. So you will need to track the disbursement of funds for various uses if the entire loan is not used for business-related activities. Credit card interest is not tax deductible when you incur the interest for personal purchases, but when the interest applies to business purchases, it is tax deductible. Sorry about that vehicle outside, my friends. But as I mentioned, credit card interest is not tax deductible when you incur the interest for personal purchases, but it is when the interest is going towards business purchases. That said, it's always cheaper to spend only the money you already have and not incur any interest expenses at all. A tax deduction only gives you some of your money back, not all of it. So try to avoid borrowing money. For some businesses, though, borrowing may be the only way to get up and running, so to sustain the business through slow periods or to ramp up for busier periods as well. So definitely get it, and interest can be a tax deduction. Number 9 on the list is publications and subscriptions. The cost of specialized magazines, journals, and books directly related to your business is tax deductible as supplies and materials. The daily newspaper, for example, would not be specific enough to be considered a business expense. However, a subscription to Nation's restaurant news would be tax deductible if you are a restaurant owner, and Nathan Myhrvold's several $100 Martinus Cuisine box set is a legitimate book purchase for a self-employed, high-end personal chef. Again, if you have a subscription to something that is specific to your business, to your service, that's going to be something that you can probably write off. If it's just like to Netflix and you're watching, Squid Games, unfortunately, that will not be something you can write off. Number 10 on the list is education. Yes, education. Any education expenses you want to deduct must be related to maintaining or improving your skills for your existing business. The cost of classes to prepare for a new line of work is not deductible. If you're a real estate consultant, taking a course called Real Estate Investment Analysis to brush up on your skills, well, that would be a tax deductible deduction. But a class on how to teach yoga, unfortunately, it would not if you are a real estate consultant. So if the education is relevant to your business in any way, you can write that off. Business insurance. Do you pay premiums for any type of insurance to protect your business, such as fire insurance, credit insurance, car insurance on a business vehicle, or business liability insurance? If so, you can deduct your premiums. Some people don't like paying insurance premiums because they perceive them as a waste of money if they never have to file a claim. Well, the business insurance tax deduction can help ease that dislike. I try to tell people, get general liability insurance, and it's a tax write-off, so it's not that bad. And this is exactly what the article is saying. Number 12 is rent. If you rent out an office space, you can deduct the amount you pay for rent. You can also deduct amounts paid for any equipment you rent. If you have to pay a fee to cancel a business lease, the expense is deductible too. But you cannot deduct rent expenses on any property that you own, even partially. Also, rent must be reasonable in amount. The need for a reasonableness test typically arises when you and the owner are related, but rent is considered reasonable if it's the same amount you would pay to a stranger. So keep that in mind, my friends. If you rent an office space, you can deduct the amount you pay for that rent. And same with any equipment that you are using. If you have to go to if you're a DJ, if you like music, you don't own equipment, but you want to rent equipment to put on an event, DJ at an event, well, you can write off the equipment. Sorry about that. But you can write off the equipment rental fees or your office space that you have for your small business, for your consulting business, whatever it might be. You can write all of that off. Number 13. We're getting close to the end, my friends. We're getting close. So number 13 is startup costs. The IRS usually requires you to deduct major expenses over time as capital expenses rather than all at once. However, you can deduct up to $5,000 in business startup costs in the first year of active trade or business. Examples of tax deductible startup costs include market research and travel related costs for starting your business, scoping out potential business locations, potential business locations, advertising, attorney fees, and accountant fees. The $5,000 deduction is reduced by the amount your total startup cost exceeds $50,000. So, if you set up a corporation or LLC for your business, you can deduct up to $5,000 more in organizational costs, such as state filing fees and legal fees. Excuse me, my friends. Excuse me. It says professional fees to consultants, attorneys, accountants, and the like are also deductible at any time, even if they aren't startup costs. So if you've been a business, if you've been self-employed for a few years now, well, if you decide to speak with an accountant to help you with doing your taxes and looking over all your numbers and whatnot, that's a tax write-off. If you decide to pay for some advertising to help you with getting some more prospective customers, getting more attention around your side hustle, your small business, that is a tax write-off. Business expenses such as buying equipment or vehicles aren't considered startup costs, but they can be depreciated or amortized as capital expenditures. Number 14 is advertising. Do you pay for ads on Facebook or Google Ads, a billboard, a TV commercial, or mailed flyers? Well, the costs you incur to advertise your business are tax deductible. You can even deduct the cost of advertising that encourages people to donate to charity while also putting your business name before the public in the hope of gaining customers. A sign advertising holiday toy drive sponsored by Robert's Hot Dogs, for example, well, that would be considered a tax deductible. So, yes, if you are self employed, you don't have to be a registered full on business to use things like advertising as a tax write-off. You are still trying to drive people to purchase your services, to work with you as a independent contractor, as a freelancer, or as a business, in which that would qualify as a advertising um, option that you can potentially write off and have it be tax deductible. And last but not least, if you are self-employed, I got to make more videos talking about the Roth IRA and just getting your or traditional IRA set up, but retirement plan contributions. One deduction you can take going into business for yourself that is especially worthwhile is the deduction for self-employed retirement plan contributions. Contributions to SEP IRAs, simple IRAs, and solo 401ks reduce your tax bill now and help you rack up tax-deferred investment gains for later. For the 2020 and 2021 tax year, for example, you could feasibly contribute as much as $19,500 in deferred salary or $26,000 with a $6,500 catch-up contribution if you're $50 or older. Plus, you can contribute another 25% of your net self-employment earnings after deducting 1/2 of self-employment tax and contributions for yourself. So the total maximum contributions cannot exceed $56,000 for 2020 and $58,000 for 2021, not counting catch-up contributions of $6,500 if eligible for both contribution categories with the self-employed 401k. Contribution limits vary by plan type, and the IRS adjusts the maximums annually. Of course, you can't contribute more than you earn, and this benefit will only help you if you have enough profits to take advantage of it. The bottom line is that most small business tax deductions are more complicated than this brief overview describes. It is the U.S. tax code after all, but now you have a good introduction to the basics. There are more deductions available than those listed here, but these are some of the biggest ones. Office supplies, credit card processing fees, tax preparation fees, and repairs and maintenance for business property and equipment are also deductible. Still, other business expenses can be depreciated or amortized, meaning you can deduct a small amount of the cost each year over several years. Remember, anytime you're not sure whether the cost is a legitimate business expense, ask yourself, is this an ordinary and necessary expense in my line of work? This is the same question the IRS will ask when examining your deductions if you are audited. So, if the answer is no, don't take the deduction. And of course, as I always say, feel free to reach out to a financial advisor, a CPA, someone that specializes and really focuses on these things. If you are, really hung up, lost there, if you want to make certain you are making the right moves, that might be the best thing to do. As I mentioned also, I highly recommend using QuickBooks. Even if you are going to do, work with someone else or not, I think having QuickBooks just helps to get you organized, helps to manage and give you kind of a good insight into where things are standing. And like I mentioned before, when it's tax time, it's easy to kind of convert and push that information over to doing your taxes as well. So on that note, I hope you guys found this video helpful. There are a number of different tax deductions that we covered in this video that should help you with saving, or should I say, keeping more of your hard-earned money. And that's what it's all about, making, managing, and growing that money. And by knowing all of these tax deductions, you will absolutely be able to keep more of your money that you can then reinvest in your business to help you with growing it even bigger and making it even more successful. And on that note, I hope you guys found this video helpful. If so, feel free to like this video and also subscribe to the channel so you can stay up to date on our latest and upcoming video content. But all right, my friends, you already know I got to keep it moving, but I'll see you in the next video. Peace.